and Mr. Yogesh Mathur, who would be talking on reviving the distressed debt market in India. And we are all very eagerly looking forward to what they have to say.
Thank you.
To set the background, the overhang of bad loans in the banking sector is currently a major factor behind the continuing economic slowdown in India. This much is very clear. NPAs as a percentage of gross bank assets, they started rising with the economic slowdown in the wake of the global financial crisis in India. And they rose continuously from 2.2% of gross bank assets in 2007-8, and they peaked at 11.2% in 17-18. And then they showed a slightly declining tendency, but still stood at a high of 8.5% in 1920. Then came COVID. And if you look at the latest financial stability report of the RBI, which I think came out in June or July 2020, the RBI now expects NPAs to climb to 12.5% in 2021 under a business as usual scenario, and 14.7% in the if the COVID-linked crisis is not controlled or escalates further. Now, this lingering banking crisis has adversely affected the demand and supply of credit. And one of the features of the current slowdown, right from after the global financial crisis, is that private investment has shown a declining trend and has shown no tendency to really pick up from the decline from about a decade ago. And this is linked to the banking crisis, which has affected both the demand and supply of credit. And the crisis has also clogged the transmission channels of monetary policy. And this is of particular concern in India, is because if you look at macroeconomic policy, it seems to have relied much more on monetary policy than fiscal policy as a tool to revive growth. So if your main instrument, the transmission channels are clogged, it's a matter of real concern. And lower rates are not leading to, the increase and supply of credit. So NPAs had risen during the last boom bust cycle as well. So this is a feature we know of downturns. When there's a downturn, the increasing bankruptcies and, the loans turn sour. And as growth revives, the NPAs also decline, and which is what happened during the last credit cycle. So, it had from around 15.7% in 1996-97, it went down to 2.2% in 2007-2008. But this would not happen if there is an underlying crisis in the financial system, which is what seems to be the case now. So some policy intervention is probably required. So what are the policy interventions? Well, the first is, of course, the bailout of the banking system through write-offs and recapitalization. This is using taxpayer money.
I can hear.
Is there a problem? Okay, that is one. Secondly, you have the IBC, which is basically has a resolution mechanism, which was traditionally weak in India, but you had the IBC passed a few years ago, and maybe the slight decline in NPAs, despite growth not picking up, could be due to the IBC. But the third mechanism would appear to be the market-based mechanisms of the kind which I think the speakers would be talking about today. Can it reduce the load from the fisc, from a bailout of the banking system, and from resolution mechanisms? So what role did have market-based mechanisms played in resolving banking crises in the late 90s? And what is the role they have played over the last few years? And more importantly, going forward, what is the likely role these mechanisms could play in resolving the current crisis in the banking system? Can they, and are they likely to reduce the need for taxpayer bailouts and reliance on the IBC? So with these words and perhaps rhetorical questions, I will now request Dr. Rohit Prasad and Mr. Yogesh Mathur to talk on reviving the distressed debt market in India. So over to you, Dr. Prasad.
Thank you, Mr. Sheel. Am I audible?
Yes, I can hear you clearly, loud
Okay,
and clear.
great, wonderful. So it is indeed an honor to speak at ICRIER along with my co-author Yogesh Mathur. And one wishes, of course, that one was speaking in happier times. The loss of Isher is indeed a big loss, you know, for the economics community all over the world. And we start with a small homage to her. So you have already set the agenda, you have set the stage, so to speak, Alok. So we don't need to do that. As you have mentioned, the uh, the NPA crisis is indeed one of the major bottlenecks to economic revival, and all methods available need to be used in order to ameliorate the crisis. And what we are going to talk about today is indeed certain market-based methods to do so. In particular, methods related to what are called asset reconstruction companies, which were set up as part of the Sarfezi Act in 2002. And they have had a checkered history in India. Largely, it has been a history of tepid volumes of transactions, except for a brief spurt of about a year in 2013-14, when there were suddenly very high volumes in the market. And again, the volumes have dropped. And this is indeed a matter of concern. The big question that we want to ask is, does the regulator look upon the ARCs as mere agents of the bank or as principals in the stressed debt market? And by this in particular, we mean, are ARCs expected to be economically viable, absorbing both the risks as well as the rewards of the stressed debt market? Uh, we will argue that there has been a slight ambiguity in the approach of the regulator. Sometimes the ARCs are allowed to take the rewards without the risk. At other times, they are expected to bear the risks without the rewards, and we need to strike a balance. So today, what we're going to do is to present to you a small economic model looking at the gains to trade in the NPA market, in the transaction between the bank and the asset reconstruction company. And we are going to use that model to make various comments with regard to the design of the market for NPAs and beyond NPAs to the stressed asset market as a whole. Here, this slide, it gives you a small brief overview of the process used in the stressed assets market.
Rohit, you have to present here. You have to share your screen, I believe.
Sorry. I thought my screen was viewable.
No, no, it's not.
You have to share your screen.
I'm so sorry. 1 second. I am somehow, 1 second. Yeah, okay. Can you see my screen?
Yeah, I think you now started. That's right.
Can you see my screen, please?
Yeah. You
Yes, now we can.
Start with the first slide and just flick it through.
Sorry. I'll just continue. I think because
we can carry on. Yeah.
Can just carry on. I think the point here really is that the stressed debt market can be divided into two parts. One, of course, is the NPA market, but that's a downstream market. The upstream market is the market for what are called special mention accounts, which are assets of the bank which are looking a bit risky, but have not yet slipped into the NPA category. And they slip into the NPA category when there is a default against any payment due and 30 days have elapsed. So there is this upstream market, and ARCs are not allowed to participate in this market. They enter the picture once this special mention account is deemed to be an NPA, at which point the ARC can buy this particular asset. And of course, once they buy it, what they do is they create a trust and create and securitize the asset, which means that they divide this asset into many small securities and hold it for transactions in the secondary market for securities. In other words, these securities can be sold to other financial entities further downstream. And they can also be redeemed in case the corporate debtor undergoes a resolution process in which some buyer buys out the company and comes to a negotiated settlement with the creditors of that company, at which point the securities stand redeemed. Now, one important aspect of the market is that after 5 to 8 years, the unredeemed security receipts revert to the bank. So here is an example of a clause which ensures that the risk never really leaves the balance sheet of the bank, because there is always a chance that it will come back to the bank after a period of 5 to 8 years.
Yeah, I'm just sorry to interrupt for a moment.
Yeah.
Just a clarification for those who are watching. If you have questions, just type them in the chat window, and then we will at the end read them out. Carry on, please. Sorry.
That's fine. Thank you.
No, thank you. So yeah. So now there are there are broad classes of solutions to trigger the market. One, of course, is the provision of government subsidy, either directly or in the form of the creation of a bad bank, which is financed by the government. The second would be the integration of the SMA market and the NPA market in order to reap the advantages of any complementarities between these two markets, or to allow cross-subsidization of the NPA market by the SMA market. There is another one which is looking at the capital structure and sources of funds of the ARCs, if that could be rationalized in order to allow easier access to capital for this market. These are things which we will touch on peripherally, but the main thing which we will look at are the bullets related to optimal securitization and the removal of inefficiencies in the market. These inefficiencies stem mainly from the structure of the RBI rules, as well as the specific market design of the NPA auction. Now,
there's some problem. Hello.
Can you see my screen? Hello. Hello.
Sorry, Mr. Sheel, was there a problem? We heard somebody saying.
Yogesh, can you hear me?
I can hear you clearly.
Okay.
Go ahead.
Okay. All right. So we will deal with optimal. Our approach to the problem is to create a model of what we call the gains to trade in the market between the two entities in the market, which is the banks on one side and the ARCs on the other side. Now, before we dive into the details of the model, it's perhaps important to remind ourselves what are the factors involved in optimal securitization. Securitization is useful and necessary in such a market because it allows the prospect of future gains to alleviate present stressed market conditions. It allows diversification in order to manage risk. It therefore opens the possibility of attracting a cross-section of investors. However, too much securitization means that the ARC is not having to fork out much cash, present cash, and therefore sufficient risk has not been transferred to the ARC. So the question we asked is, what is the optimal mix of cash and security receipts in the market? Okay, so we create a model which allows us to compute the minimum cash proportion acceptable to the bank and the maximum cash proportion acceptable to the ARC in a transaction of an NPA being sold from the bank to the ARC. And this minimum, these cash proportions, these threshold cash proportions are a function of the market parameters, which include things like the cost of capital of the ARC, the level of premium the ARC is able to generate over the value, the recovery that the bankruptcy process, the IBC generates, and so on. We will have a more detailed, intimate look at these parameters in a brief moment. The model, therefore, can be used to indicate what are the orders of magnitude of changes required in the parameter values to achieve market feasibility. And this model can be applied at different levels, at the level of the economy, or at the level of a sector like the power sector, or even at an individual transaction level between a single bank and a single ARC. The model will also allow us to understand the volume of additional capital required to revive a certain sector or a certain transaction or even the economy as a whole. It also crucially enables us to, it opens up the path to examine optimal auction design for the NPAs. Okay, so the way we model it is we think of the bank as having two alternatives. One is the IBC, which is the bankruptcy route, where the NPA, the corporate debtor, is declared bankrupt and the matter is taken up by the IBC. The second is where the bank, rather than selling to the, rather than taking the NPA to the IBC, it sells the NPA to the ARC. These are the two possibilities open to the bank, and the bank will be willing to do the transaction with the ARC only if the returns given by the ARC are greater than or equal to the returns given by the IBC. That basically is the heart of the model with respect to the bank. Let's look at the details of the process. So the bank compares the present value of the, as I said, expected returns from the IBC and the ARC processes. Now, when it sells an NPA to the ARC, it gets paid in two forms. One is in cash and the other is in security receipts. As we said, the ARC takes the NPA and puts them in a trust and securitizes the NPA. Okay. Now, part of these securities are held in the name of the bank. The remainder are held in the name of the ARC itself. The part which is held in the name of the ARC represents the cash which the ARC has given to the bank for the NPA. Now, what does the incremental value added by the ARC with respect to the IBC process depend on? It depends on a bunch of parameters. We've already alluded to some of them. Here, I would just like to allude to the parameter K, which is the share of cash in the transaction. We are going to focus on this quite strongly. We are also going to focus on F, which is the management fees percentage charged by the ARC for the security receipts. So when the ARC is holding securities in its trust in the name of the bank, it charges the bank a management fees for those security receipts. There are other extraneous factors also which come into play. For example, accounting gains which are afforded to the bank as a result of RBI provisions and so on. We'll come to those in detail later. Now it's time to dive directly into the mechanics of the model, the arithmetic of the model. So what is the incremental value of the bank relative to the IBC? Okay. One is, of course, the cash component. Suppose we assume that the deal value is V, represented by V. So, for example, suppose that the book value of the asset in the books of the bank was 100 rupees. And suppose that the deal value V was 40 rupees. Okay. Out of this, let's say 40% is in cash. So how much would be the cash component? 16 rupees, right? And what would be the security receipts component? It would be 24 rupees. Now, how does the bank value this combination of cash and security receipts? Of course, if all 40 rupees were given in cash, the value would be simply 40. Okay. But if all 40 rupees were given in security receipts, the bank would not value it at 40, it would value it at less than 40 on account of the risk associated with the security receipts, right? So there is a risk aversion parameter N, which we apply on the security receipts component of the deal. So suppose the bank got 40 rupees in security receipts, it would value them. Let's say, suppose the risk aversion was 0.5. Then the bank would value it at roughly about, 6 rupees approximately. Okay, 6.5 rupees. Now, but the bank doesn't have, it's not all in security receipts. Remember, only 60% of the deal is in security receipts. So we say that the bank values the security receipts component at 60% of 6.5, okay, which is approximately 3.8 rupees. Okay, so now, and of course, the cash component 16 rupees, it values at 16 rupees. So now we understand the bank's valuation of this deal, which is in a combination of cash and security receipts. It's 16 rupees for the cash component and about 4 rupees for the security receipts component. So it's about 20. Okay. But we're not yet done because the bank also has to pay management fees on these security receipts, right? So the management fees that it needs to pay on the security receipts, remember, the book value of the security receipts is still 24 rupees. And so the ARC is charging management fees on these 24 rupees of security receipts. Now the ARC charges a rate of about 1 to 2%, but we expect that this 1 to 2% will be paid every year for about 5 to 8 years, or for an average tenure, which could be anywhere between 3 to 8 years. So we take the present value of the management fees, which would become due over this average tenure, and we say that that would be the percentage that we would apply on the security receipts. So suppose we say that the management fees is at the rate of 5%. So then we would say 5% of 24, right? That would be the management fees that is due. So we get, how much do we get? We get 16 rupees for cash, 4 rupees for security receipts, and a small amount for the management receipt. So for the management fees, which is due. So it's about 19 and odd rupees, right? And we compare this amount with what the bank would expect to recover in present value terms from the IBC process. If the IBC process in present value terms gives more than 20 rupees, then we'll go with IBC. If it gives less than 19, 20 rupees, then we'll go with the ARC. Remember, currently the IBC is giving about 25% as the resolution amount, resolution/liquidation amount. But we even have to reduce that because we're going to look at present value. The IBC also takes about 3 to 5 years to to finally resolve the proceeding. So that is the arithmetic of the bank. It gives us a very nice equation, which you see right at the bottom of the screen. And this equation is actually a linear equation in K, which is the cash proportion of the deal. And we require that this incremental value be greater than or equal to 0. This allows us to get the minimum cash proportion which would be acceptable to the bank given the prevailing values of SI, which is the resolution from the IBC, V, which is the deal value, N, which is the risk aversion parameter, F, which is the management fees percentage. Okay, so this gives us what would be the minimum cash that the bank would require to do the transaction. Now, if we were given the we were given a certain cash threshold which the RBI mandates, which is, let's say, higher than what the bank would normally give under a given situation, we can then calculate what is the necessary change in the values of the other parameters, B, F, N, SI, in order to make the transaction feasible at the RBI's mandated cash proportion. Now, this gives you what we call the market minimum cash proportion of the bank. There is another very important cash threshold which the bank has to think about, which is the cash threshold which emerges if we substitute the fair value of the NPA instead of the deal value. Now, remember, in an efficient market, the deal will happen at fair value, but markets are often not efficient. In fact, we are going to argue that the market for NPAs in India disincentivizes efficiency. So the deal value in general is not equal to the fair value. But we could ask what would be the cash threshold for the bank if the deal value were the fair value, right? So the question, of course, now arises, what is the fair value? How would you define fair value? And here's how we define it. We say the fair value of an NPA is equal to the amount that the bank could get from the IBC process, 20-25%, times the premium that the ARC would be able to generate over the IBC process. In other words, the value addition that the ARC could bring about through things like securitization, asset reconstruction, etc. Right? So we say that the deal value should be P times P, which is the premium of the generated by the ARC, times SI, which is the is generated in the IBC process. Now, so all we do in this second equation in this slide is, instead of V, we substitute P times SI. And once we do that, we get the fair value cash threshold. Okay, so that's where we are at. Just check for time.
I think I need to move, move on.
Yeah. All right. Okay. So yeah, let's move on. So this basically gives us the graph of the bank's incremental value with respect to the cash proportion. Notice that it's an increasing graph, which means that the bank would ideally like to get 100% cash, but of course, there is a cash threshold K star B, at which the bank is breaking even, and beyond which the bank is making profits. So K star B represents the minimum cash that the bank would want. Now, this particular graph is drawn with respect to a given value of the other parameters in the market, the risk aversion parameter, etc. But we need to understand how this graph shifts as the other parameters shift. So what happens if the risk aversion parameter goes up, right? The graph will shift in a downward direction, which means that the minimum cash the bank would want increases. The bank becomes more cash hungry. What happens if the management fees increases? Again, it's obvious the graph will go down, the bank's cash requirement will increase. What about the premium generated by the ARC? Now, this is a bit of there's a bit of a nuance here, because remember, when the premium generated by the ARC increases, the deal value, the fair value of the deal is expected to go up, which means that the management fees paid by the bank would also go up. So it's not clear a priori whether this would lead to an upward shift or a downward shift of the graph, but we've checked for feasible parameter values. This results in an upward shift of the graph. That is, if the ARC generates more premium, the bank's demand for cash will reduce. Now, the last one is quite fascinating, the surplus from the IBC SI. What happens to the bank's demand for cash, or really the incentives to transact in the ARC market, if the returns from the IBC process, which is the alternate process, goes up? That's an interesting question to think about. Now, the answer is that the incentives in the ARC market could go down if the IBC process starts generating higher returns. Now, that's no surprise, but it could also go up if the ARC, if the IBC starts generating higher returns. So there are ranges of parameter values for which the IBC market and the ARC market are actually complementing each other, which is an interesting point. All right, so having done with the bank, let's go on to the decision process of the ARC. The ARC is basically getting paid, looking at two things. They are deploying a certain amount of capital in terms of the cash component of the deal. In return for it, they're getting to get a certain number of securities in their own name, and they're getting management fees. So they're getting paid in two ways: the security receipts, which are held in their name, and the management fees. And their investment is the cash component of the deal, right? So you can get a return on investment for the ARC, and you can basically compare that with the cost of capital, and the ARC will transact if the return on investment is greater than the cost of capital. So here you see what we have. We have the return that the ARC gets on the SRs, and we do the identical procedure for ARCs as we did for the banks with respect to discounting, risk discounting the SRs held in the ARC's name. Okay, so we just use a risk aversion parameter given by M. Now that's K times V to the power of M, which is the return on SRs. And then there's the management fees, which we've already seen. It's identical to the management fees which the bank has to pay. And the investment is given by K times V, which is the cash component of the deal. And we, from this, to get the net return, we take out Z, which is the total cost of capital. And if this return is greater than or equal to 0, the ARC will transact. Now, this again gives us a very nice linear equation in K, which allows us to calculate the maximum cash proportion the ARC is willing to stomach in order to do the deal, right? And this is what we get, this equation that you are seeing on your screens. Now, the graph of the ARC is a downward sloping graph, which obviously means that ideally the ARC would like 0 proportion of cash, but there's a point at which the graph cuts the x-axis that represents the highest cash proportion the ARC is willing to accept. And if the cash proportion is lower than that threshold, the ARC is willing to transact. Now, how does this graph change with a change in the parameters? If there is an increase in the risk aversion parameter, the graph shifts down, which means that the ARC has a lower cash tolerance. Okay, if the maximum amount of cash that the ARC is willing to give comes down. Similarly, it's obvious that if the management fees goes up, then the ARC, there's a better deal for the ARC. The ARC is willing to have a higher cash tolerance. If the cost of capital goes up, the ARC will have a lower cash tolerance. If the deal value goes up, then the ARC has a higher cash tolerance. Okay. So now, therefore, we can bring together these two graphs to see if we have a feasible or an infeasible market. And we can see here that this is an infeasible market because the minimum cash required by the bank is greater than the maximum cash permissible for the ARC. And now, of course, if we have an infeasible market, we can do a variety of things with the parameters. We know which direction the parameter takes the respective graphs, so we can see how to shift those parameters in order to make it feasible and make it look something like this, where basically the minimum cash required by the bank is less than the maximum cash permissible for the ARC. Now, how do we estimate the parameters from the market data? Because this is all theory so far, but we need actual values of the parameters. And luckily, there is data we can use, or there are measures we can construct from the data, which will basically span all the variables of the model. So the deal value, remember we said the book value was 100, the deal value was 40. How do we get the deal value? So you can look at the total value of the security receipts held by an ARC at a particular point in time and divide that by the total book value in order to of the NPAs held by the ARC to get the deal value. Okay, the cash proportion, you know the security of the security receipts held by all the ARCs. There are certain security receipts held in the ARC's name. You divide those securities, the value of those security receipts, by the total value of the security receipts held by ARCs to get the cash proportion. The recovery from the IBC SI can be based on data from on IBC proceeds, along with some discounting and some average tenure of the IBC proceedings. The management fees is quite obvious. It's readily available from the management fees percentage prevailing in the market at a particular point in time and the average tenure of the security receipt. The premium P that the ARC generates can be generated by dividing the deal value by the recovery from the IBC SI. Now, this particular point, I'm going to put a little question mark on it, because this is only assuming that deals happen at fair value. Okay, so if deals don't happen at fair value, then we can't really estimate P. And the risk aversion parameter of the bank. Now, this is an important point. How would you estimate what is the risk aversion parameter of the bank? So we know that the banks, there is a certain book value of the SRs. So remember, in the example that we were talking about, we had total deal value of 40 rupees, 16 rupees in cash, 24 rupees in security receipts. And so 24 rupees is the book value of the SR. Okay. Now, there is a process by which these security receipts, which now are seen as an investment of the bank, these security receipts are marked to market. So if SRs have been doing well, then perhaps they would stay at 24 or close to 24. But if the SRs haven't been doing well, the secondary market and security receipts is not good, they would be written down a little bit. So there is a mark to market value of these SRs. So N is the value of N is that value which satisfies this equation. Book value of SRs held by a bank raised to the power of N is equal to the mark to market value of those same SRs. Okay, so that's how we get N. M, the risk aversion parameter of the ARC, can be obtained in the same way. Now, one of the ways in which we can apply this model, as we said, we can apply it also to individual transactions. So one thing we can say is that suppose a market is infeasible. Suppose a particular transaction is infeasible because, let's say, the cash component that the ARC is willing to give is lower than the minimum cash that the bank requires. Then we could say what would be the kind of investment or capital infusion which would allow this transaction to happen. So we calculate that in the following way. The ARC's cash threshold we put in the bank's equation, okay, and calculate the values of the other parameters, P, V, F, etc., which would allow this particular bank's equation to be satisfied with the ARC's threshold, right? So for example, if our focus is on P, the variable P, then we could ask what is the P star which would allow this equation to be satisfied and for the market to become feasible. And then we know what is the current level of P, and the P star divided by P would give you an indicator of the order of magnitude of capital infusion required in the debtor company in order to make the transaction feasible. This is just one way in which it could be applied to individual transactions. There are others, I won't really refer to them now. So we've already, to sum up what we've done so far, we've understood what are the parameters which are relevant to this market and how to, which direction they take the market in, and therefore what to do in case we find an infeasible market. Okay. There is another way in which the RBI has used to fix an infeasible market. This way actually does not operate on the basis of economic variables, it operates on the basis of accounting benefits. And what the RBI has said is that it has the broad structure of the rule is that if a certain minimum cash proportion is satisfied in the transaction, then the bank gets relief on provisioning. Remember, when a bank has NPAs, then every year the bank has to set aside a certain amount of money as provisions against those NPAs. Now, if the bank sells the NPA to the ARC, then of course it gets cash, partly it gets security receipts, which are shown now as an investment in the investments of the bank, right? In addition, the bank also saves on provisioning provided the minimum cash proportion is satisfied. Okay. Now there are certain nuances involved in this rule. I won't come to that. I will mention one important point, that this relief on provisioning also is available in the case of a transaction with the IBC. If the NPA is sent into the IBC process, also the bank gets relief on provisioning. Broadly speaking, the difference in the provisioning or the additional provisioning which the bank gets on account of dealing with the ARC rather than with the IBC is equal to the difference in the deal value of the ARC and the recovery value in the IBC. Okay, this difference represents the additional benefit on account of provisioning. Once we look at this delta, this increment, we find that actually accounting benefits may not play such a big role. Also, they don't really play a big role if the assets, the NPAs, are old and they've already been written down. All right. So what this does basically is seen by the following graph. It basically shifts the bank's graph upwards, but only to the right of the minimum cash proportion stipulated by the RBI. Okay, so this is how the graph would look like if K dot is the minimum cash stipulated by the RBI. And now notice what has happened is that we started off with an infeasible market because, and now we've ended up in a feasible market. Okay, so this is what the accounting benefits can do. But they also come with they also bring a certain amount of inefficiency into the market, which can be seen by the following graph. You see here that at the minimum cash, that the transaction is infeasible without the accounting benefit. But the transaction is also infeasible with the accounting benefit, because if you were to look, just one second. If you were to look at this point K dot, right, the ARC is making losses if the cash proportion is at K dot or anything greater than that. So the ARC is not willing to do a transaction at the cash proportion stipulated by the RBI. Despite now, the inefficiency lies in the following fact, that the bank is making strictly positive profits at K dot, at that cash proportion. And it's making profits which could well compensate for the losses the ARC would bear if it did a transaction at K dot. And yet the transaction cannot happen because there's no way you can transfer the surplus from the ARC to the from the bank to the ARC, beg your pardon. So what we are going to do to fix this rule is to introduce a sliding scale of accounting benefits. Not have a 0-1 rule that if you are below K dot, you get no accounting benefits. If you're above K dot, you get 100% accounting benefits. What we're going to say is that if you achieve a certain cash proportion, you get 100% accounting benefits. If you achieve less than that cash proportion, you get 85% accounting benefits. So we introduce a sliding scale which reduces this inefficiency. Now, there is another very peculiar thing which happens with this particular rule the RBI has introduced, which is the following. I'm trying to change my slide. Yeah. So now look here at what has happened. The RBI has set a very high minimum cash stipulation of K dot, close to 90%. That's the current situation. Notice that the bank, even without the accounting benefits, would be happy to transact at K dot. It's making a profit at K dot, even without accounting benefits. But the RBI has, given it, has sweetened the deal even more by giving it accounting benefits. So the bank is in clover, and the ARC is making huge losses at that cash proportion, right? So this is a very peculiar situation which has been generated on account of the particular specific numbers chosen by the RBI for the cash thresholds. Now, we come to the last part, and perhaps the most important part. I have spent about, I think, 35 minutes. I will, Alok, with your permission, spend another 10 minutes, if I may.
I think.
Okay.
Yes, Mansi?
No, I thought, sir, maybe you got logged out.
Okay.
No, fine. No worries, sir.
Yeah, I'll take another 10 minutes. Now, we are now going to move away from this world of fair value and so on, and come into the context of the rules with respect to which the market for NPAs functions, which is the Swiss challenge. Now, the Swiss challenge is an auction method under which operates as follows. When an entity receives an unsolicited bid for a particular project, the entity receiving the bid throws open the bid to other market participants and says that I have received a bid from Mr. A at, they are going to do this, maybe build a bridge for me, and they're going to charge me $100 million. Can you build the same bridge or a better bridge at a lower price? Okay, that's what's a Swiss challenge. So at the heart of it, it's what we call a sealed bid, which means that there is no counter bidding allowed. Sealed bid, first price, which means the winner pays exactly what they bid. It's a reverse auction. Sealed bid, first price, reverse auction. It's reverse auction because it's the sellers who are bidding and who are trying to reduce the price. Okay, each is trying to outbid the other in the downward direction. So it's a sealed bid, first price, reverse auction. Now, this methodology appears to be quite incongruous with respect to the market for distressed debt in India. Firstly, in India, these auctions are initiated by banks. They are the ones who are reeling under the weight of the NPAs and are only too keen, eager to put these on the block. Okay, and there is no element of innovation that is involved, because innovation is another thing which is incentivized through the Swiss challenge, but there's no innovation involved here. Okay, so for both these reasons, this appears to be an incongruous auction design. What we recommend is a multiple round ascending auction with a fixed number of rounds decided in advance to replace the Swiss challenge. Now, this market has no room for innovation, but it does have room for one very important variable, which is the cash proportion. So our second recommendation is that cash proportion needs to be an integral part of the bid. So every bidder needs to submit two numbers. One is the total value of their bid, which is that there is a book value of 100 rupees. What is the value that you bid? Is it 40? Is it 45? Is it 35? That's one. Second is, what proportion of this are you willing to pay in cash? Okay, so each bidder submits two numbers. Okay, and the two numbers are converted into a cash equivalent by using a formula which incorporates the risk aversion parameter of the bank. We've already said how that risk aversion parameter can be calculated, right? So we incorporate that and we publicly announce it before the auction, right? So every bid is converted into a cash equivalent. Now this incentivizes higher cash proportions, and it does one important thing. It also reduces the deal values. Now this will appear strange because usually when we talk about auction design, we talk about increasing bids. But here we are saying that this reduces bids, and that's a good thing. Why is that? Please look at this particular aspect of the market. Both the bank and the ARC gain by an increase in deal value. The bank gains obviously because its NPAs are valued at a higher amount. Okay, and the ARC gains because when the deal value is higher, then the base upon which the management fees are calculated are higher, and therefore the ARC also gains the higher the deal value. So this is a peculiar market. The buyer wants higher deal values, and the seller also wants higher deal values. The seller wanting higher deal values is less strange, but the buyer wants higher deal values. Right? Now, what's bad about this? What's bad about this is that these are short-term considerations we are talking about. Take the case of the bank. If the deal value is higher than the fair value of the NPA, then tomorrow, 6 months down the line, the bank is going to have to write down the security receipt, right? And therefore will have to take a loss at that point. Let's look at the ARC. If the ARC's deal value is higher than fair value, then it will have to sell the security receipt in the secondary market at the higher value. Therefore will suffer losses, will be unable to transact in the secondary market, and therefore will make this entire transaction less valuable for the bank going ahead, right? And therefore, what will happen is that this market will start getting dampened in the future on account of this artificial inflation of deal value. So what we recommend here is that this artificial inflation is really driven by the management fees component of the ARC's gains. And what we say is that in case the ARC is unable to actually resolve this asset and has to take recourse to has to use the recourse provision after 5 to 8 years, then part of the management fees should also revert to the bank. And maybe this should not happen after 5 to 8 years as currently suggested, but maybe after 10 years. Now, that really is the sum and substance of what we are going to say on the basis of the model. However, we have a couple of more policy recommendations and then we close. One, we need to integrate the SMA and the NPA markets. The ARC should be allowed to buy assets which are stressed but not NPAs. These are more attractive assets, and the sooner that these assets get resolved, the better, the lower the number of NPAs which will be generated. So this needs to start happening. Currently, this is a moribund market because the expectations in this market are set completely wrongly because of the high volume of NPAs in the market. Therefore, any buyer in this market expects that they could well be buying an NPA. So you have a market for lemons in the SMA market as well. Secondly, we say that reduce the stipulated cash proportion to about 40%. Thirdly, we've talked about the sliding scale of accounting benefits. We've talked about replacing the Swiss challenge with a multiple round ascending auction, where both the deal value and cash proportion are included in the bid, and the clawback provision. Finally, what I would like to end with is a small triangle. We talked about the optimal cash proportion. What is that optimal cash proportion? Does our model give us an answer? Well, sorry to disappoint you right at the end, but the answer is we don't give you a formula for what's the optimal cash proportion. However, we do give you a triangle. What is on one side of the triangle? One side of the triangle is a well-functioning bankruptcy process. The other side of the triangle is or let's say smooth capital markets. Now, when I say smooth capital markets, I mean that there has to be a flow of capital, which is neither speculative nor too risk averse, both in all segments of the economy, including in the market for the downstream market for security assets. And finally, we come to the specific of the market, correct market design for the NPAs, right? Where we talked about how the Swiss challenge has to be modified. If we have these three in place, the market mechanism will generate the optimal cash proportion. So with that, I would like to end. Yogesh, if you have anything, if I have missed out anything, please you can mention it, or we'll take questions now.
Thank you, Dr. Prasad. Does Yogesh have anything to add, or should we move on to
only
the questions?
No, I think, well, I mean, frankly, I have been actually trying to answer the questions on the chat too. So obviously we can see a certain thought process that is emerging. I think one or two general points. Of course, the subject has been a much wider subject, but our focus has been, and as you've seen in the presentation, very much onto the subject of the transfer or sale of loans, and we are seeing that as quite shall we say, upfront in the thinking of the RBI today, because we've seen some of these issues coming up for debate in recent draft circulars that the RBI has come out with, more notably in the month of August, where they actually came out with circulars to widen the definition of securitization, as well as to widen the participation of sale of security receipts, as well as they in fact very specifically asked for public comment on whether the existing Swiss challenge method, which exists today in the process of sale or potential sale, whether that is considered to be most appropriate. And we have, based on some of the work we've done, actually given some of these suggestions that we are sharing with you to the RBI. So we've focused on particularly this area. Of course, there, as you rightly mentioned, Mr. Sheel, there are wider areas. The other is that I think the context that was set right in the beginning is very much forefront for us, which is basically that the original purpose has always seemed, it's always seemed that the original purpose of the RBI and the government in setting up ARCs has been veering towards more the so-called agency model and not the principal model, which means basically on a non-recourse basis, taking over risks and having sufficient ability to fund and capitalize, large chunks of NPAs and move them off the balance sheet. That has not been the model, and hence it's been necessary to obviously keep on fixing the type of regulations, and we're suggesting some more, that if that doesn't get replaced by a principal type model, which means a bad bank or something equivalent, then how can the existing system actually, shall we say, be modified to be able to make the market active again? So that's been the background of our thinking, just to explain. Happy to take questions, or even take up the questions on the chat box.
Mansi, have we received, how many questions have we received?
So on Zoom, we have about, I think, four or five questions to which some Yogesh has already responded. On YouTube, there are only compliments, actually, saying that it was a great presentation, and I'd like to add that I think I've learned a lot. So so the questions, so if you open up the Q&A button on your screen, so you'll be able to see the questions.
Yeah, and I can take up, just mention straight away that frankly, the first one was not answered because I think I pressed the wrong button and said I'll answer it live rather than on chat. So therefore, I haven't answered it, but I can, tell you what my answer is. The valuation for different NPAs, it is true that all NPAs, have a different valuation, but ultimately the models everything in proportion to the value carried in the books of the banks, whether that is a debt value or NPA value. And yes, we eventually are trying to address, that was an early question, we are trying to address how to incentivize both banks and ARPs to transact. That was, what we concluded with, if you notice. I don't know if there are more.
Ed, are there any other questions? Unanswered questions, Mansi?
So there's one, okay, so you've answered, and there are some others that Yogesh has already answered, but if for the interest of everybody, if you'd like to discuss them anyway, would you like me to read them out, or?
Yeah.
I think read them out, yes.
Sure. So the first question is, it says ARC's return is largely dependent on various factors, including the secondary market for NPAs, the success of ARC in turning around the SIC unit, and many other factors. How can that be incorporated in the valuation model at the outset? That's the first question. Then there's another one. Does RBI or banking regulators in other countries allow transfer of NPAs to ARCs at below fair value? Then there is another question. How frequently are the security receipts issued by ARCs? Are MTM in India under RBI SEBI framework? What are the major factors that have an impact on M2M? And the open question was already taken up by Yogesh. I mean, he just answered it a couple of minutes back. So,
What is M2M?
Mark to market. So I actually went ahead and typed some answers to these questions, and if you like, I can read them out as well as you take up any further clarification. So on the ARC's return, the model actually models a return expectation, which is like a percentage return on capital employed, which tends to be, at the outset, before they look at a transaction, the ARC tends to have a certain return on expectation, which is obviously linked to ultimately their cost of capital and the levels of risk that they see themselves taking. It is clearly variable from case to case, but there is a certain range of expectation, and the model basically, takes that into account. If the model is looked at a macro level, it would take an average sort of range or average level. If it looks at it from a particular deal standpoint, it would tend to have an expectation specific to a transaction. The point about RBI or regulators in other countries, my own understanding is that all evolved jurisdictions across the world have tended to gravitate towards an arm's length of fair value, unless there is a positive incentive. There is a need to push an asset off the balance sheet, which means that the bank will actually take a hit in order to get it off the balance sheet. The variations across the world are in how fair value is determined. And in the case of our model, the other factor that we brought in, which is a big factor, we believe, in our ARC market, is the manner in which it is settled. So how is the fair value settled between the two parties, the bank and the ARC? whether it is part cash upfront, whether it is by securitization combination, and then the tenure of the securities. And those are factors that have tended to be driven by RBI regulation, RBI wanting that particular aspect to be addressed in a particular way, which in fact is meant to work in favor of the banks, but it in the end also can result, as we have seen, in stalling the market. So that's what happens vis-a-vis elsewhere in the world. In terms of the frequency of mark to market in India, I believe it used to be, it has varied. It has been annual, it has been quarterly, and from what I recollect last, it's probably 6 monthly or so now. But that's still not the key factor for us in terms of the model. The frequency of mark to market for security receipts is only how quickly are you looking at the real value of the SR. The factors are certainly important, and the factors are ultimately, since the security receipt is linked to cash flows from a particular debtor, then in the end they are linked to all the parameters that affect that debtor's ability to service the SR. So it's really business and the business of the debtor and the kind of, let's say, macro and micro parameters that will lead to a variation or change in the expectation of cash flows from that business. So those are clearly the parameters. It's about basically giving the asset a workout by securitizing the debt and enabling that securitization to be transferable. And the challenges we face, we see in the market are about A, creating those securities, and B, about being able to sell them to potential investors, which is actually a big factor, which we should discuss further. Which is basically that those security receipts are now meant, in the recent past, the RBI expanded the potential of who could buy security receipts to include certain international investors as well, who are actually specialists in this area. But transactions have still been limited and selective, and we can see the type of reasons that drive that.
Okay, I have two clarifications. These are more factual clarifications rather than theoretical. The first is, as I understood it, is that the banks would like to maximize the cash inflow, and
Yes.
the ARC tries to minimize it. But did I hear
That's
somewhere that the regulator, the RBI, has set a threshold of 90%? So if and the numbers which were talked about by Dr. Prasad was in the range of a much lower sort of the examples which he gave. So will this actually kill the? I mean, would it be a non-starter at this level?
In fact, it has. What the RBI does is that it stipulates a minimum level at which a transaction can take place. So, below a certain level of cash, a transaction cannot take place. But it has recently gone to set a higher level of, it used to have that threshold at which a transaction would take place, as well as at which accounting benefits would be available. And then what it did was, it actually increased that accounting threshold benefit to the level of 90%. So it basically said, Mr. Banker, you can sell your ARC, you can sell your debt to the ARC, but if you want the accounting benefits, you better collect as much as you can in cash. And that's where the challenge came up, because then the ARC needed to have the capital and the return expectation from that capital to justify a large transaction, and that became a challenge. Sorry, am I?
Yeah, I think absolutely. Thank you. That was absolutely on the ball. And the point I think which we need to emphasize is that even though transactions can happen at lower cash thresholds, for some reason the RBI's sort of recommendation with respect to accounting benefits becomes the de facto minimum cash at which banks
want
transact. Now, whether it is to do with the fact that they are public sector banks,
if it's not the accounting benefit level, the maximum possible cash, they don't care, because they're not going to get accounting benefits anyway. So they then don't care as to what the level of cash is. They simply want the asset to be off their books and not bother about SRs, and that has actually been a very big dampener. Part of it you can even attribute. I mean, we tend to attribute. I've been in that market off and on for a number of years, and seen these phases, and you tend to attribute a chunk of their shall we say reluctance to the fact that they were used to the idea that they would get accounting benefits when such a transaction was to take place, but they're now not getting them anymore.
So, and the other thing to answer your question, Alok, is that the market can still survive by an artificial inflation of deal value. And in fact, that's what's been happening. If you look at the deal value in the market, it's now at 70% of book value.
In the early
It used to
stages,
be 25%, then it moved up to 40% in 2013-14. Now it's at 70% with no real reason for this movement. It's only that the bidders are, who are the ARCs, are saying, well, if you want us to give you 90% cash or 80% cash, we are going to jack up the deal value so that our management fees goes up.
so
which
really, really what, and that's the reason, these are the parameters. You actually asked a very core question, Mr. Sheel. The reason for our recommendations is in fact some of these parameters, that some of these drivers, because what we're actually trying to do is to say, can we actually come up with recommendations that still enable the market, but at the same time don't encourage the bank and the ARC to come up with, let's say, contrived levels or artificial levels. There should be deals that happen at real value, and then that real value should be lucrative for both the banker and the ARC. And as Rohit said at the early stages of his presentation in the beginning, the parameters have changed in such a manner that the deals have been either beneficial to one or the other, but never equally to both, so to speak.
Oh, have I got logged out or?
No, we can
hear you.
We can hear you. We can hear you. I think your video is has just frozen.
Okay,
Yeah.
probably facing a poor connection.
Yeah, but we can perhaps hear him still.
Yeah, if we can wait for like
No
a
problem.
minute,
problem.
just so that in case he has any concluding remarks.
No,
but it was
no,
a great
problem.
presentation, and I've learned a lot
you.
today.
I hope so.
So thank you so much. I'm going to actually go over the entire presentation again to make sure that I've understood it in its entirety. I was trying really hard to keep up.
Thank you so much, Mansi, for the opportunity.
Thank you.
Not at all. Totally our pleasure. Yeah, like I suspected, he's got logged out. Can we just wait for 1 minute
No
to
problem.
see if he'll join back and if he has any closing comments? Otherwise, we'll close the meeting.
You had Gemini and Shoaib, who wrote that paper on ARCs a while ago, Mansi, in ICRIER. I guess they're no longer with ICRIER, or?
They used to be at ICRIER, both of them. Yeah, they're not at ICRIER.
So is this Zohaib 8602 the same person who actually asked a couple of questions, I believe?
I'm not sure. No, he was Shoaib. I don't know if Zohaib and Shoaib. I don't.
Okay.
Yeah. No, and Gemini sir also had like I think a year or maybe a 2-year stint as RBI chair, and then I think sir's back.
Yeah, sorry, I've been having a very unstable connection today. So the other, since I worked from the side of the government rather than the other side.
Yes, I heard so. We heard so.
So the first thing which comes to my mind is, why would the regulator be insisting on this a high cash inflow? And the first thing which strikes me is that there would be the fear that the securitized portion of becoming a new round of NPAs on their own.
That's right. In fact, what happens is that because there is recourse to the banks, the securitized portion has a tenure of 5 years, extendable 1 year at a time, I believe, based on justification, extendable to 8 years, after which it actually devolves back onto the banks. So they have exactly that fear. But the flip side of that is that since the ARCs who are buying the debt off the balance sheet of the banks are aware that there is ultimate recourse, then their shall we say approach to the whole transaction would tend to be different, because they're not going to be left with an ultimate big loss. So they know that in the meanwhile they're going to get their fees for managing whatever they can manage, and that in the end the banks take the hit. So you haven't really created a principal to principal transaction. You've in fact just got the ARCs acting as the extended arm of the banker, and you're paying for them.
And also one important point, Mr. Sheel, is that if if you were to keep the current threshold of 90%, then either you're going to get inflated values in the market, which ultimately are going to create losses,
Yes.
or you're going to get no transactions, which means that the NPA stays in the book of the bank anyway.
Which is what is tending to happen today.
Yeah, so that also has to be kept in mind.
And then finally, what actually is how is the market actually functioning? Have there been a large number of transactions, deals, or is it because of these various reasons which we've been discussing? The market is a rather a limp one, and the number of transactions.
No, we had a slide that actually
On
addressed
that.
exactly that question. In fact, it addressed it for over a period of about 15 years. There were 3 phases.
I must have been locked out at that time.
No, we had a slide which we didn't present, to be honest with you.
Oh, you didn't present. Okay.
Didn't present that slide. But that slide will tell you, if you were to put it up, it would tell you that in the early stages after securitization and after Sarfazi and then securitization started, maybe 2008, 9, 10, 11, there were limited transactions. And then, as Rohit mentioned, in the period 20, I think it was 12, 13, 14, that period, the RBI actually had said that, okay, we'll allow transactions where up to minimum of 5% cash. They actually said 15% first, and then they reduced it to 5% as a cash threshold and said we'll allow transactions with 95 and 5, which means that you could have 95% security receipts. But the ARC would get fees based on the percentage of security receipts. So the ARC was in a position where it could buy a fair value of 100 rupees, let's say at 70 rupees, with 5% upfront cash, which is a small number, and then get fees paid on that entire value of SRs. And at the end of 5 years or more, up to 8 years, have the entire balance value devolve back on the bank. So the ARCs actually made hay, and they therefore bought a lot of assets. And those came back and shall we say, hit the banks much later, isn't it?
And the banks also liked the transaction because the banks were getting accounting benefits. Accounting benefits.
Yeah, if in that scenario, if the SRs were valued and the transaction value SR plus cash was valued at a level higher than the real fair value, then the bank could book a profit in its book upfront, and then eventually the SR value would sort of be written down over a long period of time in the future.
Yeah.
So the banks were booking profit upfront and then writing it off over a period of time, and the ARCs were making fees on that value, even though that value didn't exist. I mean, to put it very crudely. So this is what ultimately pushed those transactions with a low level of cash. So there was a spurt, to answer your question. And then the banks and the RBI started to realize what was actually happening. And
then it flipped it.
Exactly. It flipped it to the other end. And so now there are no accounting gains, and you can do a transaction, but you have to pay for it all in cash. So nobody wants to do it. So I think you absolutely hit the nail on the head. This is the trend in the market, and hence our focus of our model. The focus of our model, as you notice, is how is the fair value settled? And actually, that's been the bane of the market. That's been the bane of the market. And hence, we're still trying to say, if you want to structurally keep this market the same, which is have non-recourse, not have with recourse transactions, and let the ARCs do their job of workout, then what can you do? And that's the subject of our recommendations. The other option would be completely scrap all this and say, no, ARCs need to buy with no recourse back to the banks, and they need to be much freer to go ahead and raise capital from wherever they want and pay for the assets. And after that, it's going to be entirely their baby. And they have to have large management teams to be able to handle it. That's a different type of market. That's not the role of the ARCs today. And that's the conversation about a bad bank.
Yes.
So hence, the reality of the situation is the RBI has set up ARCs, which could have been bad banks, but they've set them up as agencies, more like an agent, right? A temporary sort of phenomenon, and is discussing putting up a bad bank. What we're saying is, no, why don't you fix the current system so that it operates better?
But to get the NPA actually off the balance sheet, you need that bad bank.
You need the capital and the capability. So you need the capital and the capability, and the capital comes in 2 forms: to buy the asset as well as to recapitalize it. Because today, you think you will agree with me that 9 out of 10 bad assets would actually need some liquidity. they will need funding. So you need the ARC to be able to do three things. Number one, pay for the asset and buy it off. Number two, have the ability to engage with management or new management, change management, and whatever else, so that the company revives itself. And then number three, be able to find capital for it to actually grow. So these three things, the ARCs are not being designed to handle. They've been restricted, not by any other reason, but by RBI regulation. So that's the role they're being asked to play. They keep on battling with the RBI to say, allow us to do this, that, and the other. They are only allowed to borrow money from banks, very limited amounts of equity and banks. So either you fix what the ARCs can do, or you have a bad bank. That's the actual debate, yes. But what is needed is that you need to have these three capabilities somewhere in the market for the debt to go off the bank's balance sheet. Number one, capital. Number two, capability. And number three, additional capital for the asset.
Okay, I think, are there any other questions, Mansi, or any other issues or clarifications?
None.
None. So I think we have, I think we are stuck to our time quite well. And I think it's been a very interesting, fascinating discussion and education for me as to how these, mysterious markets function. And I'm sure it has been an education process for many in the audience as well. And I would like to thank Dr. Rohit Prasad and Mr. Yogesh Mathur for a masterly presentation. And thank you all very much.
I hope it was useful.
Thank you so much.
Thank you, sir.
Thank you.
Thank you.